Hey guys, Whitney here. I'm going to give you guys just a second to file into, give everybody a second to file into the session. We will find our man of the hour too. He's going to be doing this in just a second. All right. Andrew, we are live. Hi, we can't hear you.
Hold on, my speakers are jacked. Can you hear me?
Yeah, I can hear you. Can you hear me?
There we go. Can you hear me now?
I can hear you. Can you hear us?
Sorry about that.
No worries.
You know, these newfangled devices here.
Technology.
Technology.
Right? Awesome. Well, thanks for joining with us. I'm going to go ahead and get us kicked off.
Lovely.
So just wanted to say hello to everybody for joining us this afternoon. Welcome to the Passive Investing Made Simple show. My name is Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And as you guys know, many of you guys know, this is a live show where we take a deep dive into various topics related to passive investing and help you put knowledge into action, all right? So you can confidently go into your first or next investment, especially with us here at PassiveInvesting.com. But if you're looking for open investments right now, check out PassiveInvestingWithWhitney.com. You can go see our current offerings there. You can also get scheduled for future masterclasses and hop on the phone with me if you'd like. But to kick off to today's show, I have brought on our Director of Investor Relations and Operations here with us. I should say Investor Services, right? Your title just changed.
Yep.
Andrew Davis, and we are going to talk about TICs. Like, how does tenant in the commons work? How can people utilize monies they might have sitting in a 1031 exchange to get invested in real estate? Because I know for me, when I went to my CPA and they say, hey, can I take my 1031 money and invest in syndicated real estate? They said no.
Right.
Because I wanted to make sure that I was getting into a more passive environment. But before we kind of dive down that complicated rabbit hole of TICs, Andrew, I thought we could start off the conversation. First of all, just with who you are, your role is at PassiveInvesting.com.
Yeah, absolutely. Well, I always love being on the PassiveInvesting.com Made Simple show with you. So thanks for having me back. But yeah, so my role is, as you mentioned, I'm the Director of Investor Relations and Investor Services as well. And really my focus for PassiveInvesting.com is just creating a best-in-class investor experience for our now 2,000 plus passive investors that are invested with us. So everything from that initial phone call where they get to know us and get a chance to ask questions about our group and hear about our strategy and opportunities, all the way through the soft commit and PPM and funding, and in some cases the TIC and 1031 process, which we're going to dive into, and then just maintaining those ongoing relationships, right? And our goal, the investor relations team's goal and really the mandate of the managing partners is, hey, we want to build really long-term relationships with our investors. And so we have about a 70% repeat investor rate. We'd like to see that at 100, which is probably impossible because we always want new people coming into our deals as well. But really what we want is, hey, we want to be doing this as long as we're blessed with life and health for the next 30, 40, 50 years. And we want people to take that ride with us. And as we're going to talk about utilizing some incredible vehicles, doing that over the long term is an incredibly powerful way to build wealth. So I won't give away any spoilers, but that's who I am. That's what I do. My wife and I live in Asheville, North Carolina, with our puppy Piper, and yeah, that's a little bit about me.
Oh, awesome! And do you guys invest in real estate? You never talked about this on the show, but you guys also invest in real estate. Personally.
You would hope, doing what I do, right? Yeah, so yes, we absolutely do invest in real estate. We have invested in real estate for almost 10 years now. I've started very, very early, bought our first house within, I think, the first year of marriage, maybe a little bit later. And I've just continued to buy and flip and do rentals, and then have moved into a lot of LP investing as well. So we have a mix of a vacation rental portfolio that we're building, as well as being LP investors or passive investors in different syndications.
Awesome. Yeah. So we drink our own Kool-Aid is essentially.
That's right. That's right. Yes. Yeah. I 100% believe in what I'm selling. My mom's invested, my in-laws and brother-in-law, I think, are soon to be invested. So yeah, we're all in.
Awesome. All right.
Yeah.
So you guys aren't here to listen to us banter about our dogs or like investing in real estate. You're here to learn about the tax benefits of real estate, very high level, but we're going to, like I said, we're going to kind of dive down into one of those secret areas that, CPAs, I don't think, or a lot of accountants either just aren't aware about or educated on to be able to inform their clients. And so I'm super excited about this. So, but let's kick it off. Can you go over just some of the tax benefits of real estate, depreciation, accelerated depreciation, 1031 exchange, just so we can kind of orient people to like the plain vanilla part of, tax benefits associated with real estate investing?
Yeah, absolutely. So there are a number of them, and interestingly enough, I think that to a degree, the tax code informs what are really advantageous real estate investments, right? So maybe some of the people attending or watching this later, the replay may have heard of opportunity zones. That was a thing that didn't exist, I don't know, 10, 20 years ago, whatever it was, but that's a great way that real estate provides tax benefits. One of the key ways that we, as a group, as passiveinvesting.com, extend tax benefits to our investors is through cost segregation and accelerated or bonus depreciation. And so basically, and I'm saying this in a very layman's way, but this should get the concept across. With an asset, so real estate, you depreciate it over, I believe, 27 and a half years. Is that right? Multifamily real estate. Do I have that right?
Yeah, residential is 27.
Residential, 27 and a half. So what the cost segregation studies allow you to do, and basically what that is you work with a company that does this, is you can take all that depreciation that you would normally just take the value and then divide it by 27 and a half and then take that much every year on your taxes. But cost segregation basically allows you to fast forward that depreciation into the first year of ownership of that asset. So you can realize in many cases, 50, 60, 80% of your investment as a paper loss. So when you get your K1, which is just your partnership statement, because you're a limited partner and equity partner in these assets with us or with any syndicate that you're invested with, you'll see on there a depreciation or a loss line item. Now, that's not a real loss. You haven't seen that money go out of your bank account, but the property or the asset is taking that loss, and you can use that to offset any gains that you got from real estate. And so cost segregation is a very powerful way to do that and consolidate that depreciation that you would normally take over a long period into a short period. Another really powerful way is when you do renovations on a property, and I sometimes conflate these, so forgive me if I do that, but accelerated bonus depreciation, basically you can take the 100% of any capital expenditures or improvements you make to a property in the first 12 months and depreciate that. So if you buy a $20 million apartment complex and you do a $5 million value add project and you deploy that whole $5 million in year one, then you can also utilize that to reduce your taxes or utilize that as a loss as well. And so those are some of the common ways that your typical LP is going to experience the tax benefits of larger, more institutional quality real estate. And then the 1031 specifically, the beautiful thing about the 1031, and this is something that's been utilized forever and ever, and something we as a group have utilized internally. We're actually in the midst of today doing our final numbers on an internal 1031 that we're doing. So I'll talk about that in a moment, but the 1031 for an individual investor is a really, really powerful way to defer capital gains. And so everybody I imagine knows what capital gains are. You're going to be taxed either short-term or long-term capital gains based on how long you held an asset. So let's assume it's long-term. So we've held an asset for longer than a year. Say we took an asset from $1 million, just to use very easy numbers, $1 million or an individual investor took it from $1 million to $2 million. That profit would be considered capital gains, long-term capital gains, and you would be taxed, I believe, 21% of that. I have not looked at the tax code in the last few weeks, but I believe 21% is the long-term capital gains number. And so, on $1 million gain, that's $210,000 that when you close, that's going straight to Uncle Sam. The 1031 exchange allows you to defer those capital gains taxes and take all of your profits tax-free, or tax deferred is the better way to say that, and exchange them into a like kind asset. So you can exchange from, say, a like kind, it generally just needs to be a similar type of business in real estate. So you can exchange between asset classes that can get a little bit nuanced depending on what you're exchanging from, what you're changing into. We can talk about qualified intermediaries and their role there. But basically what a 1031 allows you to do is defer your capital gains taxes. And technically, we have a great article on the website about this. It's called Swap Till You Drop. Technically, you can do that until you pass away, and then all of your real estate can be passed to your heirs. And when that occurs, the basis, the tax basis, or the tax owed, the gains are reset. And so your heirs, in theory, have no capital gains tax obligation, and you've been able to grow your wealth tax-free in that manner. So those are some of the tax benefits of real estate.
Very important that you don't gift that real estate to your heirs. Right? Yeah. So you got to actually. Well,
I would not even attempt to step on your toes. You're the generational wealth lady. You can talk more about that.
Well, yeah, I mean, because I know I've talked to several investors that are like, yeah, I want to be able to set up and gift this real estate, before I pass to my heirs. I'm like, no, talk to your lawyer, talk to your CPA about it. But I believe that's the last thing that you want to do in order to take advantage of that step up in basis, especially if you're doing the 1031 exchange, because you've been exchanging and reducing your basis in your properties. And so your basis will be incredibly low, which means if you did gift it, you would have a very huge tax bill. So, but if you don't, if you hold on to it, then it would go on to your heirs, and, more than likely, you'd get that step up in basis. Of course, there's, tax laws change. And, I think, if you're trying to pass on, I don't even know what it is, guys, now, 4 million or 10 million, I'm not there yet. I want to be there.
Don't we all?
Yeah. All right. So we touched on that. There was another, question that came in is about DSTs, because that's another way to, for people that are coming out of an asset that has, produced a gain for them, possibly going to 1031 exchange, they can't identify a new property. DST, Delaware Statutory Trust might be a viable opportunity for them. We don't do DSTs, but I know right. DSTs are available with a lot of investment bankers. But you still have the same issue with getting the adjusted basis correctly, the loan basis correctly, as well as getting that cash flow and the returns that you want. Now, all right, kind of shifting back, you've alluded to the tax code, and there's one main problem here that I see is that there isn't really a good way for an active real estate investor to exchange property into a passive investment. And as I interpret the tax code and when I've been educated by my CPA is that because it's not a like kind exchange, right? You're trading real estate for a business.
Correct.
Yeah. So the IRS kind of said no back in 1924. In 21 they said yes. 3 years later they went, nope, we got to put this like kind of exchange ruling in place. Now I know a lot of accountants tend to give challenging advice to their clients who are selling properties and can't do a 1031 exchange into passive deals, which is simply is untrue. And that's where I want to kind of highlight what you the process you take charge of here at passiveinvesting.com is that there is a way. There is a way.
Yeah, absolutely. And I think you touched on one really important point, which I want to highlight. for all of you real estate investors out there, if your CPA does not know and is giving you advice that you later find out to be incorrect, I recommend you get a new CPA. And there's CPAs that are very, very well versed in the tax benefits of real estate and how to utilize different tax structures and depreciation and all these different things. And there's CPAs that aren't, that are just your more typical CPA, or they're more focused on businesses or whatever it may be. So no insult to CPAs that are not familiar with this. This is a bit of a niche part of the tax code, but would definitely recommend that you work with a CPA that invests in real estate and then is well versed in it to make sure that you're taking advantage of all the tax benefits that exist. So yes, one of the ways, or the way that you can 1031 into a syndication is basically utilizing an ownership structure called a TIC, which is an acronym. It's TIC, and it stands for a tenant in common structure. And so effectively, that in common, if you look at, and this is where I need a whiteboard, but I don't have one, so y'all have to suffer through my hand visuals here. So if you look at the asset itself, right, you've got the apartment, you see the house here, and then you've got basically what you would have in a typical syndication is you would have a GP LP. You'd have the GP or the operator, you'd have all the LPs, 100, 200, whatever it may be, there in an entity that owns that asset. With a TIC structure, when somebody 1031s in, they cannot 1031 into that entity where they would be next to all the other LPs. They have to actually 1031, or in an LLC or an entity with all the other LPs, they would actually move into what's called a tenant in common entity or structure that owns alongside the operating entity, or the GP-LP entity owns a piece. So if you look at it, rather than everybody being in the same entity, you've got the GP-LP, and then you have a tenant in common that sits right alongside that. So you would think, well, but aren't I passive? Wouldn't then I not be passive if I'm effectively a co-owner of this asset? And the way that we work around that, in order for you to have all the protections that come with being an LP or a passive investor, so no liability for debt or issues on the property or whatever. That's one of the beautiful things about passive investing, is you have no or extremely little legal liability. Is we utilize a special purpose vehicle kind of in between the TIC and the asset itself. And so, well, from an entity perspective, the TIC is alongside the operating entity. From a functional or practical perspective, it sits in the same position as an LP in terms of the returns and protections.
So can anybody, because I know, I mean, imagine there's a lot of people listening that are like, because asset prices are high, it's an amazing time to sell. It's also, if you're going into 1031 exchange, quite possibly the worst time to buy because of the high asset prices. So functionally, if a TIC, somebody is listening here, they're like, ding, 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 this is amazing. This is what I want. How does it work?
Yeah, absolutely. So kind of nuts and bolts of it. So we'll use we'll change the names to protect the innocent. We're working with a bunch of people that are selling properties that they're selling real estate where they've been managing it or operating it, and now they want to take those proceeds and move them into a passive investment. And so basically what happens is, when you go to sell and you intend to do a 1031, you want to work with what's called a qualified intermediary. And a qualified intermediary, to use again a very layman's kind of description, it's almost like an escrow account for a 1031 exchange. And so they are going to hold the proceeds, because one of the key things with a 1031, whether you're 1031ing it into another asset that you actively own, or 1031ing passively into a tenant in common structure, is you cannot touch that money. And so when you sell that asset, your proceeds, which would be your principal and your gains, you never see them. They never hit your bank account. They go straight into a bank account, an escrow account with this qualified intermediary. And basically from the time you sell, and one of the challenges with a 1031 exchange and a TIC into a passive investment or a syndication is that you have a couple clocks that are running simultaneously. And so you signify your intent to do a 1031 exchange with a qualified intermediary, you sell, you make $1 million or $5 million or $100,000, whatever it may be. And then from the moment that sale occurs, you have 45 days and 180 days. And both of those clocks start at the same time. You have 45 days to identify up to 3 properties or assets that you would like to exchange into. And then you have 180 days to actually make that exchange or close on those assets. And basically, when you want to 1031 into a syndication, you would work directly with somebody like me, where we would be running through your timing, the amount that you're looking to exchange, what we have in terms of deal flow pipeline, et cetera. And then really just figuring out, hey, what your investment goals are, and then also what falls within kind of that 6-week window. And of course, if we can line both those things up and you can exchange into your perfect investment, awesome. But by the same token, sometimes it's, hey, your 45-day identification window does not always coincide with the best, or the most robust deal flow that we've had in a given time. And so there does need to be some flexibility on the part of the passive investor to understand that, hey, we're not going to force a deal just so you can have something to exchange into, and realize that maybe you've never invested in storage before, but storage may be the only option for you right now as well. So I always encourage folks when they want a 1031 to have multiple options, because you do not want to get to, and I've been in this situation several times with investors where you get down to 5 days left, 3 days left, and we can do everything that we do at passiveinvesting.com, and a deal can fall through. And then if you've only identified one deal, or something doesn't come through that we thought was going to fall through, you're in trouble. And so I always encourage people to have multiple options when they're looking to 1031. If they're looking to 1031 into a passive investment, to have multiple operators that they're talking to, and multiple potential assets to exchange into.
Now, and for people that are hearing this and going, oh my goodness, timelines, what happens if it falls through, right? There's, you want to have a plan A, plan B, plan C, right? That's why they give you 3 assets. And also, we're going to recap a plan D here in a little bit. I'm going to tease you guys with it because you got to stay to listen to it. But so a couple of questions come up for me. One, what is the investment minimum for this? And then 2, it's kind of like tax tail wagging the dog a little bit. What is actually the most fundamental thing that an investor should be looking at before they actually go into a TIC with an operator?
Well, who the operator is. I mean, I think so. You can look at pro formas all day, right? But I mean, so for us, so we'll answer this in sequential order. So minimums for us are $500,000 or $1 million for a 1031 exchange. $500,000 if they're going to exchange into a storage asset, and $1 million if they're going to exchange into a multifamily asset. And that's actually low for the industry. So we know other sponsors that have a $2 million or a $3 or $5 million minimum. The reason for that is many operators choose to, I guess, discourage 1031 investors, because from an operational perspective, and the reason we have these minimums is it's very logistically challenging. It requires setting up additional entities. It requires a lender approval, which, depending on the lender and the asset and the debt markets, can be very, very challenging, and it requires significant additional ongoing reporting as well. And so for us, those minimums are in place really to ensure that we don't have everybody that sold a rental with $150,000 to exchange, we have 27 TICs. Usually lenders are going to limit it to 4 or 5, but then also for us, just administratively as well, making sure that we can service and provide, great service to those folks that are 1031ing into deals with us. So 500,000 for storage, $1 million is the minimum for multifamily. And then, before you ever look at a deal, make sure you really trust that operator, because that's a big chunk of capital to invest, and you're taking a ride with them for 3 to 5 years or however long the life cycle of that asset is.
Awesome. Okay, so I have several questions that are coming in. They're getting into kind of nitty gritty, and we are going to answer those. But I want to make sure we stay pretty high level right now.
Yep.
What is the process? If somebody is sitting here going, "Oh, this could be the most amazing opportunity for me," what is the process to kickstart this?
Reach out. Reach out to me. Reach out to another operator that you want to Whitney, of course, yeah, to passiveinvesting.com, right? Whoever the people are at the operator or the company that you want to work with, and really communication is key, right? And so we have a spreadsheet of every single person that is in some phase of a 1031. I know exactly when their identification windows are. We know what they're exchanging into, and so really communication very, very early on, and then as what I ask folks to do is, hey, if you want a 1031, let's talk about that. Make sure you understand the process. You're comfortable with us as an operator. Let me know when your closing date is. Let me know when you close, right? And then we can have very frequent communication, especially during that identification window, to make sure that that they're getting into some good assets, right? And that they're lining up with their timing requirements. But then really the process is, okay, assets identified. And then once they identified and elect to say, hey, they're going to 1031 with us, then the process goes to, they're going to be working with one of our managing partners to really, it's very simple, but there's some additional layers there to get lender approval for the TIC. There's some additional information that we require to get it all set up for them. And then once we've done that, that's all done pre-close. So then when we go to, on closing day, we're obviously wiring funds from our equity account with all of our LPs and GP co-investment. But then however many TICs are in that deal as well, all those qualified intermediaries are going to be wiring their funds on the same day as well in order to close and co-own that asset. So that's the high level.
Awesome. And for those of you who are like, man, how do I even find a qualified intermediary? Guys, I interviewed Dave Foster, I believe back in April. Any of you guys can reach out to me. I'd be happy to make a connection. I've used him personally for my 1031 exchanges. And so I can speak really highly of him. And, we definitely have other recommendations for you too. But it's super important to get them involved before you sell that initial asset, right? So because once you take possession of those funds, the 1031 is now off. You cannot do it. Even if you're 3 days before closing, you can still get a qualified intermediary involved. It is not.
That's right. It's not too late. You can do it. You can do it the day before if you can get somebody on the phone.
Right.
Yeah.
They might. Your title company may not like you.
Oh. They definitely won't.
But it can be done. Yes. Okay. So I had a question come in, and I'm selling an asset and I only have $150,000 to $170,000 in gains. Can I not do a TIC? The answer is, it depends. Right?
It depends.
It depends. It depends, because, Andrew's already alluded to that different operators are going to have different minimums, but there's a reason why these minimums are high. Now, guys, I remember I teased you a little bit. I did an episode at the end of May over the lazy 1031 exchange. And so that is a perfect opportunity for those of you who are here going, oh man, like I don't have $500,000 or $1 million in my exchange. Go back and watch that episode. You can reach out to me. I'll send you the link. That is an amazing opportunity for you to be able to move these funds from an active space into a passive space. And maybe, you might not offset all your gains or all your depreciation recapture. We can certainly help you offset a majority of that or a large chunk of it. And so again, that episode is up on YouTube. It's called the Lazy 1031 Exchange. Essentially, you're taking possession of your capital gains and reinvesting the boot and the capital gains into a syndication deal that's going to, like Andrew said, going to throw off that high capital, cost segregation depreciation, high bonus depreciation. And
you use some jargon there, Whitney. What is the boot?
The boot, meaning your initial capital invested. You have to do it all.
Yep.
You have to do initial capital invested as well as the gain. Now, Do you have to do that if you've already taken possession of your funds? Andrew, I'm going to get ahead of you on this question. No, you don't. But if you're wanting to realize as much loss as possible, you should. In a 1031 exchange, you have to take your initial investment as well as the capital gains forward. You know, in a lazy 1031, you have a choice. Okay, you can quote unquote what we call consume it. All right, guys, I've got a lot of specific questions here, but I'm going to just tease out a couple ones, and then we're going to move into our after party. And for those of you who are like, I've got specific personal situations, you'll be able to pick Andrew and I's brains as long as you're very gentle. But Andrew, who is this investment? Who is it TIC for, and who is it not for? Let's just quickly recap that.
Yeah, I think a TIC is for, you know, I think a TIC is for somebody that is looking at some really big capital gains implications. You know, somebody asked if I have 150 to 170K, can I not do this? You can absolutely do a 1031 with 150 to 170K, but those gains are going to be, you know, maybe you're selling a duplex and you roll them into an 8-plex. Or maybe you're selling a single family home and you roll them into a vacation rental or something like that. So you can absolutely do a 1031 with lower amounts. I think it's very, very important to distinguish a 1031 and a TIC. TIC really, at least, I mean, the TICs are used in different formats and different ownership structures, but for our purposes, 1031 and the TIC is only when you are going from active ownership into passive ownership, and you're wanting to be in a syndication or 1031 into a syndication. So I think a TIC is for somebody who A, does not want to actively manage real estate anymore. B, has some very, very large capital gains tax implications, and C, has a comfort level with the operator that they're investing in. That's very, very important, that you really trust who you're investing with, because ideally when they sell that asset 3 or 5 years down the road, you can 1031 again, and you can just keep doing that over and over again and continue to grow your wealth tax free. And so I think, I mean, you know, a lot of people can do them, but I think it's for somebody that A, wants to really be in a passive position, has a large capital gains tax implication, and then it has a strong degree of comfort and trust with the operator that they're effectively handing over their hard-earned money to, or maybe not that hard-earned money, but either way, it's money.
Right. Yeah. Okay. So the question I always ask everybody that's on the show, what is the top thing that you want investors here to walk away with?
I think that I think that there's always we're in an interesting market cycle and political environment right now. So there's always a lot of fear about, you know, what if this goes away, et cetera, et cetera. I think if you look at the history of the tax code, if something goes away, something new pops up. There's always somebody in Washington that is making it advantageous for people to invest in real estate. So I wouldn't be overly concerned about that. I think really, I think for somebody that's considering this, being very proactive is very, very important as well. And really knowing what they're looking for and some criteria, kind of what they will and won't budge on, if you will. And, in that way, when they're starting to look and evaluate different sponsors and different opportunities, I would say cast a wide net or paint with a broad brush. And so that way you have a lot of options. But that's what I would say. And then I think very, very important as well, especially for people that have smaller gains or don't want to defer capital gains down the road, where they're going to have an even bigger potential tax bill and they're concerned about that in the future. The lazy 1031 is a beautiful option. There's so much you can do with depreciation and a good kind of tax strategist / CPA to offset a lot of capital gains obligations. And then you don't have to worry about kicking the can down the road. So that's what I want people to know, is there's definitely other options. I know there were some questions about a DST. We don't really work with DSTs. I did send a resource there. I think it can be great. It's a different structure. And I think that in the people that I've talked to that have looked at DSTs, they've found that the fee structure can be higher than what they would like. And oftentimes the returns are not as good. However, I've not spent a ton of time deep diving that, so I would certainly encourage people to look at the other options there as well.
Yeah, definitely. And DSTs, we did an episode with Brett Swartz, I believe,
perfect.
early March. And so there's two different ones, right? There's a Delaware Statutory Trust, and then there's a Deferred Sales Trust. And I think, Andrew, what you were just talking about there is the Deferred Sales Trust for sure.
And Donald Smith asked, can I do one of these questions here? Because I'm real excited. I have a visual.
Yeah, totally.
Okay. Donald Smith asked, what does the org chart look like compared to a typical LPGP syndication? So I'm going to do this. This is real bad, but here we are, right? And so basically what you have is you have TICs invested via special purpose vehicles, and then they own the assets. So I don't know if y'all can see that, but it's basically what I was describing earlier. So TIC, special purpose entity, asset. TIC, special purpose entity, asset. And that special purpose entity is what allows the TIC to have the protections afforded to the LPs. So
awesome.
That's my chicken scratch structure.
We gotta get you learning. We gotta learn you. Whoa, this is my great.
You gotta learn me, Whitney.
We gotta teach you how to use Zoom whiteboards.
There we go. Yeah.
All right, guys. Thank you for those of you who are live. Thank you so much for joining us today. Don't go anywhere. We are about to start our after party session, our Ask Me Anything section. And then for everybody that is listening, thank you so much for joining me today. If you are looking to register for future masterclasses, learn about our open deals, and just connect with myself and even Andrew and his team, you can reach out to me at passiveinvestingwithwhitney.com. I've also dropped both of our emails in the chat box for those of you who are here live. Guys, thank you so much for taking your time out today, your most important resource, to not only spend it here with us, but also invest it in yourself.
Absolutely.